There's a reason why the Rockefeller family is one of the wealthiest families in the entire world. And it's not something that happened by default, it's something that happened by design. Now, across all of my social media platforms, we have a little more than 1 million followers who are constantly engaging with us, asking questions, really trying to get to the heart of the matter of taking their life and their business to the next level. And financial literacy has been something I've been passionate about for decades. And I want to take this opportunity to teach you guys what the Rockefellers have done and how they've been able to maintain the status of the wealthiest family despite generation after generation and potentially even being exposed to challenges within a particular generation. I want to dispel the myth that what the Rockefellers did is reserved only for the uber wealthy. Don't get me wrong, if you're uber wealthy, you definitely want to be employing these strategies. The frameworks by which the Rockefellers have been able to not just amass, but to maintain massive fortunes is because they took the framework and applied the framework consistently. What is the framework I'm talking about? It's essentially how they've incorporated and utilized structures and leverage vehicles in order to keep more wealth generation after generation. What you need to understand in the United States is that we are taxed pretty much at all aspects of the journey of a dollar. If you go out and you earn money, you're taxed on the amount you earn, right? It's called an income tax. If you go out and then spend that money and buy something, oftentimes you're taxed on that purchase as well. That's called a sales tax. And then if you did buy something and it created in value, meaning there's more value at the end of the period of time when you're ready to sell that thing, you're also taxed at that point in time. That's called a capital gains tax. And certain property that you buy, just by sheer ownership of that, you're taxed every year on that. And what I'm talking about there is the concept of property tax. And here's the kicker. When you die, you're often exposed to taxation as well, especially if you've amassed a significant amount of wealth. And different states have different rules at the state level with regard to whether or not they tax a person when that person dies. The federal government has its own set of rules with regard to whether someone is taxed when they pass away. These taxes are often referred to as estate taxes and or inheritance taxes. And what the Rockefellers understood was that if you could shield a portion of your wealth from that taxation, generation after generation after generation, that alone creates massive opportunities for you and your family, because taxes are an erosion of wealth. They are literally the government reaching its hand into your pocket, into your wallet, into your bank account, and taking a portion of it. Now, don't get me wrong. I know there's a lot of different opinions regarding taxation. I have my own. I hate the government. I hate the IRS. I think that the concept of taxation is theft. That's my personal opinion. How can you leverage what currently exists within the law to use that leverage to your advantage to keep more wealth in your family generation after generation? And that's literally what the Rockefellers have done. They went to a number of very intelligent attorneys and posed a question. We want to keep more money in our pocket for our family forever. And those attorneys were then set to task. They were told to go out and figure out a strategy by which to employ so that the goal and objective of keeping generation after generation of wealth alive actually rung true. What I can say is this: the methods that were used worked. And that's why we can look at two remarkable families in our history here in the United States, the Rockefellers versus the Vanderbilts. Now, arguably, the Vanderbilts were way wealthier than the Rockefellers, meaning the massive wealth that was accumulated in the Vanderbilt family in that first generation of wealth building was way larger than what the Rockefellers amassed. But don't get me wrong, the Rockefellers still won. One, if you're measuring the concept of winning and losing with regard to how much you got to keep. Because the Vanderbilts, generation after generation, have had significant erosion to their wealth to the point in time where, realistically speaking, you basically have Vanderbilt University, which is the legacy piece of that wealth that has lasted the test of time. But the reality is Vanderbilt's is nowhere near positioned financially, not even close to what the Rockefeller family has been positioned. And again, it all happened by design. So let's talk a little bit about that design. The attorneys went back and they said, okay, what could we do utilizing the law to separate wealth from exposure to estate taxation? And what they came up with is the utilization of trusts. Now, it's important to note there are a lot of different trusts that exist in the United States, but there are two main categories of trust. One is what is referred to as a revocable trust. The other type of trust is what is referred to as an irrevocable trust. A revocable trust is a document, a private agreement that you, as the person who created that agreement, you can change at any point in time. It is completely or partially revocable by you. You can modify it, you can tear it up if you want, you can do anything you want with it because it is truly 100% revocable. Irrevocable trust. That you cannot change. Essentially, once it's set in stone, it is nearly impossible to undo. And the reason or the method that the attorneys for the Rockefellers utilized, they utilized irrevocable trust. So what they did is they aggregated a certain amount of wealth and pushed it over into the irrevocable side of the spectrum. Now, in order to do that, you need to understand how the tax code works a bit. An irrevocable trust is an entity truly separate from you. It is not an alter ego for you. It is literally its own entity. And therefore, it has its own tax ID number. It has its own tax schedule. It pays its own taxes. It files its own tax return. A revocable trust, on the other hand, is simply just an alter ego for you. It does not have its own tax ID number. It doesn't have its own tax returns that it files. By the nature of this irrevocable trust being its own entity, monies that leave your bank account and get put into that irrevocable trust have now left your control. Here's another interesting point. It's not that it leaves your control entirely, because remember, you drafted the trust agreement. So you get to stipulate what that trust can and cannot do. You also get to safeguard the resources that get put into that trust so that they are not exposed to outside forces like creditors and litigants. You are safeguarding the wealth for the family. But again, that irrevocable trust is its own entity. So dollars that shift from your control to the control of the trust have now literally left your hands. And when that happens, that means those dollars are no longer exposed to the dreaded death tax, the estate tax. Because when you pass away, the trust still exists. Nothing has happened. It still owns the assets. And therefore, there is nothing to tax at an estate tax level with regard to those assets that are held within that irrevocable trust. What the Rockefellers did is they leveraged that trust vehicle. They said, okay, let's form these irrevocable trusts and shift some of our wealth into those trusts during our lifetime. It's important to note that there are three key individuals that are associated with any type of trust, whether you're talking about a revocable trust or an irrevocable trust. They are the grantor, meaning the individual who establishes the trust, the person who actually sets it up, who actually puts assets into the trust. They're putting the resources that they've accumulated during their lifetime into that trust vehicle. The second key individual is the trustee. The trustee is the individual who literally manages that particular trust for the purposes that trust was established to accomplish. The trustee in an irrevocable trust is someone separate from you. You are the grantor in an irrevocable trust, but the trustee is someone who is separate from you. Because if you served as trustee and could make distribution decisions, then you actually have control over those assets in real time. It's called constructive receipt. Having that would subject them to estate taxes for you. So you don't want that. You would have a separate trustee. And the third individual or individuals that is associated with a trust are what are referred to as a beneficiary. Any individual that derives benefit from the assets maintained within that particular trust, that is a beneficiary. It could be one individual, it could be multiple individuals, it could be other entities. There's so many different things you could do, but those are the three specific individuals that are associated with trusts. And what the Rockefellers did is they established these grantor irrevocable trusts. They shifted money from themselves into those trusts, managed by a separate third-party trustee for the benefit of future generations. That, by its very nature, that just alone helps with regard to maintaining wealth in the family. It doesn't create necessarily perpetual wealth, but it definitely helps maintain wealth because it limits the exposure of those assets to the dreaded estate tax, the erosion of wealth generation after generation simply through taxation. Here's the thing that the Rockefellers have done that is so remarkable. I can't highlight this enough. They understood the power of a particular financial tool, and that tool is referred to as life insurance. Don't get me wrong, I am not a fan of sales tactics and tacticians that engage in life insurance on a day-to-day basis and utilize concepts and strategies to try to sell life insurance policies without really understanding what those policies are or how how the fee structures work. That in and of itself is also a discussion for a different day. But I just want to talk about the tool of life insurance. You see, life insurance by its very nature is simply a contract that you engage in with another company, a financial company, and they will guarantee something in return in that contract. Meaning you pay them money and they guarantee something in return. And the very base level of a life insurance policy is you pay a premium over a period of time and they guarantee a death benefit to a beneficiary that you get to name. So what the Rockefellers did is they started utilizing life insurance inside of the trust, meaning the trust vehicle, the irrevocable trust vehicle, was specifically designed to not just receive cash, but also to purchase inside of that trust life insurance on the life of the grantor. What that created now is for every dollar that went into the trust, there were multiples of dollars created based on the potential of a life insurance payout at some future date. There's a lot of nuance here, but just understand that a life insurance contract at its very base level, you pay a premium, and in return, the life insurance company guarantees a death benefit for the person who was insured. And in the case of the Rockefellers, you had the patriarch who was shifting money into this irrevocable trust in which life insurance was being purchased on the patriarch's life. That adds to the creation of wealth within the trust because you've shifted wealth to the trust, but you're creating even more wealth in the trust when the patriarch passes away because there's now more death benefit, more proceeds get added to the corpus of the trust. There's more assets now available for those future generations. But here's where the leverage comes in generation after generation. See, what the Rockefellers did is within that trust dynamic, they didn't stop with the purchase of life insurance just based on the life of the patriarch. What they did is they started buying life insurance for every generation that was currently alive. Here's where it really took off. Not only did they do that, they built within the trust ecosystem, they built a mandate for the trustees of those respective trusts because they ended up creating multiple trusts to accomplish these goals. They built within the infrastructure of the trust for the trustee to continue purchasing life insurance for every future generation. That is perpetual wealth growth. That is the thing that created the reality of the Rockefeller family today, being one of the wealthiest families that exist on the planet. And the reason for that is every single generation, regardless of that particular individual's contribution financially to the family, the life insurance was set in place at their birth. The life insurance was put in place as soon as they came into the picture, into the family dynamic. And that means no matter what that particular family member did or did not do in order to advance the family financially, the life insurance was there as a backdrop. The biggest contention, the biggest pushback I tend to get when I start talking about this particular strategy is,
"Oh, Edward, that makes so much sense for the uber wealthy, but that doesn't apply to my scenario."
My retort is why? If you are in a position to be able to establish an irrevocable trust, and what I mean by that is you are currently in a situation where you have financial income coming in that may be in excess of what you actually need to live. You have disposable income. What is more important to you? Is it more important to you to sacrifice the future of you and your family for the things you want today? Meaning give up on what you want most for what you want now. That's the real rub here. And that's the rub for any type of planning and any type of strategy implementation. The Rockefeller family made a decision that they were going to shift money that could have been consumed by them in lifetime into this trust vehicle outside of the taxable estate. By doing so, they created an opportunity for generation after generation to have access to a pool of wealth that is second to none. And you could do the same exact thing. I'm not saying buy millions and millions of dollars of life insurance. What I'm saying is understand the concept. Shift money into an environment that can be available for future generations and start doing it now. Don't wait, don't delay, because every day you grow older, the more expensive life insurance becomes because it is priced based on something referred to as your life expectancy and your existing health status. The days you delay in putting a life insurance policy in place as a tool in the financial workbook, if you will, for you and your family, is a day that either the cost goes up or you are foreclosed from the opportunity. If you become ill at some future date, you become uninsurable potentially, which means if you delay to a point in time when you could do it later on, well, maybe you won't be able to do it later on. So even if you could do it in a small portion today, meaning not go overboard with regard to the death benefit and all of the different features, it may make sense to at least do that. The other argument that comes up a lot is the discussion between term versus permanent. When you're looking at life insurance, there are two main types of life insurance. You have term life insurance and you have permanent life insurance. Term life insurance is akin to renting your life insurance, meaning it is only in place and in force for a certain period of time. Let's say a 10-year term as an example. Because the fact that it is only in place for a certain period of time, the insurance company will essentially discount the cost of that life insurance. There is no cash value that builds up into that policy. It is literally renting the life insurance. And at the end of that period, at the end of that term, you have an option. You could renew it every year going forward at whatever the relative cost of the insurance is for you each successive year, which means you may have a term policy that has a relatively low cost for the entirety of the term, but the very next year after the term ends, that cost goes up exponentially. And then the next year after that, it goes up exponentially, and so on and so forth, until such time it becomes completely unaffordable in order to continue that policy. The other option you have is to buy a permanent life insurance policy. And there are a variety of different types of permanent life insurance policies, but at the very basic nature of a permanent policy is you contribute a premium based on some permanent understanding that the life insurance will be there the entirety of your life, meaning you will have to pay life insurance premiums for the rest of your life, but the calculation of those life insurance premiums are set at the very beginning of that policy. You have a general knowledge of what the investment for that life insurance policy is going to be continually throughout the remainder of your life. And the other thing with permanent life insurance is they often have a component in there referred to as cash value, meaning a portion of every dollar you put in is reserved in some sort of account that builds up a cash value for you, and it gives you the ability, if there's a cash value component, to borrow against that cash value. Doesn't mean that you're borrowing the cash value itself. It just means that the life insurance company will issue a loan to you and collateralize the cash value that's been built up. It depends on what you're trying to accomplish, but if you utilize the tool the right way, you may have heard of the phrase infinite banking. Well, infinite banking is essentially what the Rockefellers have done, right? They've created this generation after generation pool of wealth that just gets dumped into these trust vehicles based on the death benefit proceeds from each generation that has passed away. But each new generation has access to life insurance policies that have now been building up cash values. So they can simply go to the trustee and say, trustee, I'm interested in starting a business, or I'm interested in buying a house, or I'm interested in going to university, or I'm interested in doing whatever it may be. And the trustee can simply reach out to the respective life insurance companies and take out a loan guaranteed by the underlying cash value of the policy. And the beauty of it is you don't have to qualify for the loan. There's no lending standards other than the fact that you have to have an in-force life insurance policy that has cash value. So you, within your own dynamic, you don't have to be a billionaire in order to take advantage of this. You can start setting this stuff up now. And if you have young children, it can make sense for you to purchase a life insurance policy for them in order to do that. Now, I want to be very clear. In order to do this, you should do proper planning, because there are costs that are associated with all of this. So you should definitely not just jump in just because you've watched a YouTube video or jumped into a social media video. That's not why you should jump in. You should jump in with an understanding that, okay, this is an interesting concept. Let me talk to people who know what they're doing in this particular field. And then let me stress test what the plan, what the strategy is. And what do I mean by stress test? And this is an important component. Stress testing means what happens if I can't afford a premium in a given year? Maybe something happened within my life and I don't have the flexibility to make a premium. How does that impact things? What happens if that happens for 5 years in a row? That's what I refer to as stress testing. You need to understand what are the results, what are the ramifications for real life events. And when it comes to the Rockefellers, they did the stress testing. They understood how these policies worked, and they created generation after generation after generation of wealth creation. Because when the life insurance policies paid off, there was more money available inside of the trust, which escaped generation after generation of taxation. It is important to note there is taxation involved with trusts. But that is really when it comes to trusts maintaining income inside of the trust and not distributing that income out to beneficiaries. Trusts actually do not have very favorable tax rates. They actually pay tax rates at an elevated level at lower income thresholds. But ultimately, any income that is passed out to a beneficiary is taxed at the beneficiary's tax rate, at the beneficiary's preferential scale of taxes based on the income levels that they receive. All of these strategies, though, require time and attention for planning them out. And if you have not dedicated that time and attention for yourself, my call to action to you is this: start now. Put together a plan that can get you, your family, and the causes that you care about to the next level. Because the right estate plan in place can make all of the difference. If you really enjoyed the content that I just covered, it was all of the what's, right? Some of you may be interested in the hows, like how do I actually do it? But to be honest, in order for me to cover that, it would be a college level course. There's so much information that is required to understand all of the different hows that are part of the tactics of getting this done correctly. And there's, quite frankly, just too much for this particular type of environment. I've already taken way more of your time than you probably wanted. But at the end of the day, if you're interested in learning those hows, I do want to let you know something. I actually do cover all of the hows of doing this and so much more with regard to taking your life and your business to the next level. And I do that inside of my private membership group. It's called UpLevel. And if you're interested in learning more about it, just check out the link that's in the description below.